Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 133, and in this episode, we are reviewing the performance of the global markets during the 45th week of 2024, and now is from Monday the 4th to Friday the 8th of November. And without further ado, this is your host Jamhuri, and together, let's dive right in. We kick it off in the United States, where on Thursday this past week, the Federal Reserve approved its second consecutive interest rate cut, but opted for a smaller rate cut this time around as it continues to right-size its monetary policy stance. In a follow-up to September's 50 basis point reduction, the Federal Open Market Committee lowered its benchmark rate by 25 basis points to bring down its target range to a rate of between 4.5% and 4.75%. Markets had widely anticipated this move, which was telegraphed at its previous policy meeting in September. Unlike the previous policy meeting where one of the committee members voted against the massive 50 basis point rate cut, this time around the vote was unanimous. For your information, the Fed's policy rate sets the benchmark for the overnight interbank rate, which in turn influences the lending rate for consumer debt products such as mortgages and credit cards. Over to the United Kingdom. On Thursday, the Bank of England decided to cut its policy rate by 25 basis points, whilst at the same time raising its inflation focus as the Labour government's recent budget announcement created uncertainty about the outlook for future easing of monetary policy. The Bank of England's Monetary Policy Committee voted 8-1 in favour of the 25 basis point rate cut, which brings the central bank's key policy rate to 4.75%. This marks the central bank's second rate cut this year after it began easing monetary policy in the month of August. On Wall Street this past week, it was a strong week for equities across the board, mainly due to the huge rally on Wednesday following Trump's victory in the U.S. presidential elections. The stock market rose to another round of record highs on Friday, with the Dow Jones Industrial Average trading above 44,000 for the first time ever during Friday's session before coming to a close at 43,988. Meanwhile, the S&P 500 briefly traded above 6,000 before closing the session at 5,995. And the tech-heavy Nasdaq Composite also set an intraday record high during Friday's trading session before eventually settling at 19,286. All the three averages finished the week at record closing levels, with the S&P 500 recording a weekly gain of 4.6%, as the Dow registered a similar increase of 4.6%. Meanwhile, the Nasdaq Composite outperformed the rest of the market with a weekly advance of 5.7%. In related news, Elon Musk, who is Tesla's CEO, contributed about $130 million towards Trump's presidential campaign effort. And that investment paid off remarkably, as Tesla rallied about 29% this past week after Donald Trump won the U.S. presidential elections, for the company to achieve a market capitalization in excess of $1 trillion and added about $15 billion to Elon Musk's personal net worth. In the U.S. government bond market, the yield on U.S. Treasuries received a boost on Wednesday, with the 10-year yield popping up by 15 basis points after Trump won the U.S. presidential elections on the assumption that his pro-business policies, including tax cuts, could spark economic growth. Investors also digested the Federal Reserve's widely anticipated rate cut of 25 basis points, which eventually came to bear upon the markets towards the end of the week. The yield on the benchmark 10-year Treasury bond was set to close the week on a lower note as it dipped by 4 basis points on Friday to close the week at 4.29%. Meanwhile, the yield on the policy-sensitive 2-year Treasury note added 4 basis points to close at 4.24%. For your information, bond yields and prices have an inverted relationship, and 1 basis point is equivalent to 0.01%. In the commodity markets, the price of crude oil fell more than 2% on Friday as concerns dissipated about a prolonged supply disruption from a hurricane in the U.S. Gulf of Mexico. The latest focus on the hurricane's trajectory and intensity reduced the risk to oil production in the U.S. Gulf. Earlier in the week, oil prices fell more than 1% as energy producers shut down more than 22% of oil production in the U.S. Gulf of Mexico as a precautionary measure against the hurricane. In response to the foregoing, the price of the U.S. benchmark West Texas Intermediate crude declined by about 2.7% to close at $70.38 per barrel, whilst the price of the global benchmark Brent crude fell by 2.3% to settle at $73.87 per barrel. In the precious metals market, the price of gold dropped on Friday to record its steepest weekly decline in the past 5 months and was mainly pressured by a stronger dollar as market absorbed the implications of Trump's victory and its potential impact on interest rate expectations. Given the inverse relationship between gold and dollar interest rates, one would have expected the price of gold to pick up this week, especially after the Federal Reserve cut interest rates by 25 basis points on Thursday. However, that correlation was overshadowed by the outcome of the U.S. presidential elections, which just goes to show that the market can remain illogical longer than you as a trader can remain liquid. In response, the price of spot gold posted a weekly decline of 1.8% and eventually came to a close at $2,684 per ounce. For your information, gold is considered a hedge against inflation, and higher interest rates reduce the demand for this non-yielding asset. In the cryptocurrency market, the just concluded US presidential elections had a significant impact on the crypto market, with prices increasing across the board, but in particular for Bitcoin. Trump's high-level team is filled with strong crypto advocates, and the president-elect himself has promised to make America the crypto capital of the world. And as a result, cryptocurrencies extended their rally on Sunday, with Bitcoin touching $80,000 for the first time in its brief history. And according to CoinMetrics, the price of the flagship cryptocurrency had increased by nearly 10% over the past week and was last seen trading at $79,800 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained flat versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.21. Meanwhile, the sterling pound was priced at 167.56, and the euro was valued at 139.34. And on the regional front, one Kenyan shilling was changing hands for 28.40 Ugandan shillings and 20.82 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.52. The dollar-shilling exchange rate has now been trading at the same level of 129.20 for the past 5 to 6 weeks. This is not normal price action, because even when a currency is stable, it normally fluctuates within a narrow range. But what we are seeing now, where the dollar shilling is fixed at 129.20, this is a clear sign of market manipulation, and the only player in the market capable of doing that is the central bank. That said, the outlook for the shilling remains bleak, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased by an astronomical $737 million to reach $9.32 billion, which is equivalent to 4.8 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The massive increase in reserves was attributed to last week's approval of a fresh disbursement of $606 million by the International Monetary Fund. Despite this, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the liquidity situation in the interbank market remained adequate and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this was broadly flat at 12.09% compared to a rate of 12.10% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market increased to 54.8 billion shillings, up from 34.6 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 41.1 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 7th of November, and the central bank received bids totaling 98.37 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 410%. The central bank, however, ended up accepting only 53.74 billion shillings, and the results of the auction were as follows. The 91-day rate fell by about 51 basis points to average out at 13.44%, whilst the 182-day rate dropped by about 68 basis points to close out at 13.84%, and the 364-day rate declined by 52 basis points to eventually settle at 14.44%. In the primary bond market, the auction for the first tranche of the November bond issue was held on Wednesday, the 6th of November, and the central bank received bids totaling 33 billion shillings against an advertised amount of 25 billion shillings, representing a performance rate of 132%. And the results of the auction were as follows. For the 10-year bond, with 8.3 years left to maturity, the central bank accepted 10.28 billion shillings at a weighted average rate of 15.97% compared to the bond's coupon rate at 14.15%. And for the 15-year bond, with 12.5 years left to maturity, the central bank accepted 15.39 billion shillings at a weighted average rate of 16.29% compared to the bond's coupon rate at 13.94%. In the Eurobond market, during the week, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 7-year 2024 Eurobond increasing the most by about 10 basis points from 9.8% recorded the previous week to 9.9%. At the Nairobi Securities Exchange, during the week, the equities market recorded a mixed performance, with the NSE 20 gaining by 1.2%, whilst the NASI declined by 1.7%, and the NSE 10 and the NSE 25 both declined by 0.1%. This takes the year-to-date performance to gains of 35.8% for the NSE 10, 33.5% for the NSE 25, 27.7% for the NSE 20, and 25.7% for the NERSI. The market's performance was mainly driven by gains recorded by East African breweries, Stanbic Bank, and Equity Group, which increased by 5.3%, 3.9%, and 1.6% respectively. These gains were, however, weighed down by losses recorded by other large cap stocks such as Safaricom, which declined by 6.6%, whilst BAT and DTB Bank both declined by 1.9%. In related news, during the past week, Safaricom released its financial results for the first half of the financial year, which ended on the 30th of September 2024. The results indicated that the group's net profit for the 6 months to September declined by 17.7%, falling from 34.1 billion shillings the previous year down to 28.1 billion shillings, and this decline was mainly attributed to the depreciation of the Ethiopian birr. In July 2024, Ethiopia adopted a free-floating exchange rate policy which caused the Ethiopian birr to depreciate by about 51%. And in the process of revaluing its foreign currency liabilities, Safaricom was forced to take a hit of about 17.5 billion shillings due to exchange losses. Consequently, Safaricom's Ethiopian business posted a loss of 19.3 billion shillings, which was in contrast to the Kenyan unit that recorded a 14% growth in profit to 47.4 billion shillings. Up next is our topical issue, and this week we are reviewing the latest report by the Parliamentary Budget Office. The Parliamentary Budget Office has cautioned the government against the introduction and increase of new and existing taxes, saying it would not lead to additional revenue, even as the Treasury prepares to roll out a set of new taxes which had earlier been withdrawn with the Finance Bill for 2024 after public protests in the month of June. In a report analyzing the budget performance for the current fiscal year, that is 2024-2025, the Parliamentary Budget Office noted that despite the previous changes in tax policies, the government continues to fall short of its revenue collection targets. The Budget Office says that this points to a fundamental problem in that simply introducing new tax policies does not guarantee better compliance or higher revenue for the government. Despite a wave of new taxes, including the contentious housing levy, the Kenya Revenue Authority still missed its revenue targets for the year ended June 2024 by a massive 205 billion shillings, and this was an increase from a missed target of 123 billion shillings for the previous fiscal year that ended in June 2023. The think tank noted that the rejection of the Finance Bill 2024 following nationwide protests should have been a turning point for the Treasury to move away from the idea of always raising taxes and instead consider tax administration through enhanced data analytics and the use of technology to simplify tax processes and improve compliance. According to the Parliamentary Budget Office, what Kenya needs is not a new round of taxes every time the government feels the need for additional revenues, but instead an efficient and transparent tax system that involves the modernization of tax processes through digitization and data-driven decision-making. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, you do not attract what you want, you attract what and who you are. Think about it. Thank you, and God bless.